Welcome to another market update from Sentara Capital. I'm Will Allen. Third quarter earnings season's winding down. The Federal Reserve just completed its quantitative easing program, and the election is now thankfully behind us. So let's talk about a few of the things we're looking at going forward. From a seasonal perspective, November, December, and January are historically very strong months for the stock market. Of course, that does not guarantee good results this time around, but strong past performance can't be ignored. But the two developing issues we see are, number one, the timing of the Federal Reserve's interest rate increases, a topic we will address later this month, and two, further economic unrest in Europe. Now, this is a topic we have discussed for over 5 years here at Sentara Capital. During the summer of 2011, we saw firsthand how economic challenges in Europe can impact markets here in the U.S. as the S&P 500 fell over 18% within a 3-month period, driven by news out of Europe. Whereas the 2011 European crisis was triggered by problems in the periphery of Europe, right now it is trouble in Germany that has grabbed our attention. German GDP contracted in the second quarter. German exports as well as industrial production have recently seen a steep decline, and German consumer confidence has dramatically fallen. Add to this, the German stock market, as represented by the DAX, fell over 14% from early July through mid-October, twice the losses of the S&P 500 here in the U.S. German Treasury bond yields are down under 1% for their 10-year bond. For many years, German Treasury bonds were very similar to U.S. government yields, but with the U.S. 10-year Treasury bond currently yielding 2.25%, this is no longer the case. German investors are concerned about deflation and also worried about the lack of economic growth across the continent. None of this is good news for the country that has been the shining star in Europe for the last 10 years. An issue that is a problem not just for Germany but for the entire Eurozone is their fight against deflation. The inflation rate has been steadily falling across Europe since 2011, and the continent is now staring at potential deflation. There are 3 key reasons why deflation is so economically harmful. First, when people believe prices will be lower in the future, they will put off spending now and wait until they believe prices have been finished falling. Second, deflation raises the cost of paying off debt, causing consumers to spend less on anything that is purchased with credit, like houses and cars. The third problem is that when prices are falling but wages are not, it increases the inflation-adjusted cost of labor. That leads to companies having to lay off workers, which leads to further downward pressure on the economy. The European Central Bank is going to do everything in their power to fight deflation in the Eurozone, but we are not sure that's going to be enough. We here at Sentara will continue to monitor the developments in Europe, and don't be surprised if the recent volatility of the stock market continues. However, volatility can present investment opportunities, and the stock market's fall in late September and early October is a good example of this. The key is to watch closely to make sure that the reasons behind the increased volatility are not going to lead to large losses. Take care.